Hi everyone, thanks for joining in so far. Just thought I'd let you know we're gonna try to start promptly at 12:15. So we'll give it another minute or so just to allow a few others to join in, and then we'll begin the presentation. Right, I think we'll get started in the interest of time. Thank you guys, everyone, for joining us today. This is our second Markets Insight webinar of the year, and we're going to be talking about the quarter that's just been, so the second quarter of 2022, and talk about some of the key themes that have arisen from that quarter. Unfortunately, inflation still remains a hot topic within markets, so that's something we'll be covering today and how that's materialized. We'll also be talking about the central bank's action towards that and how they're tackling that, and as well also the talks of possible recession moving into the new year. We'll also give our thoughts moving forward, as well as some actions we're taking within the portfolios. And then towards the end, we'll give a summary of everything we've discussed. As always, there will be a Q&A at the end of the session, but please feel free to ask your questions throughout the presentation, and we'll be sure to answer them at the end of the webinar. But of course, if you can't think of anything today and have questions later on, always welcome to give us a call or send us an email. So without further ado, I'll pass you over to Mo, who's going to start with a recap of second quarter.
Good afternoon, everyone. Thank you very much for joining us. And I hope you've found somewhere to hide in this record-breaking heat. Thankfully, we're in an air-conditioned office for today. I think probably here for most of the day. As Tommy mentioned, covering off the second quarter of the year, it has once again been a tricky quarter. Unfortunately, both equity and bond markets have continued to fall to varying degrees. At the low point, which was for the US markets, and I reference here the S&P 500, which is the main US stock market, that was down 20% at its low point in mid-June. Unfortunately, the bond markets have also been caught up, and I've made reference to this in the recent past in some of my commentary, but a basket of UK gilts, for example, or UK government bonds was down by more than 15%. Also during this quarter that's just gone. We've seen that across multiple bond markets, both government orientated and those in the corporate bond space as well. So that obviously presents a very tricky backdrop for pretty much any investor, because traditionally government bonds are meant to be a source of security and a place where you can safely hold your money, but clearly that has changed. And so as a result, given that our portfolios and those of many others are dominated by both equities and bonds, or bonds, our portfolios have come under a fair bit of pressure, more so on the active side, with many falling more than 10%. As Tommy mentioned, that once again, we seem to be sort of repeating the same sort of topics, but it has been the macroeconomic sort of big picture stuff that has been dominating markets and has continued to dominate. And really, it is inflation that's ultimately causing the knock-on effects with regards to the first thing being central banks, so the Bank of England, the US Federal Reserve, and how they are responding to the environment. So as I'm sure you're well aware, UK inflation as measured by CPI has risen up to 9.1%, 9% even. And in the US, it's risen to 9.1 at the most recent reading, which are clearly very high readings over the highest we've seen in several decades. And so as a result, people like, well, places like the Bank of England are having to raise interest rates to try and tame inflation and ease back on a lot of their accommodative stance that they've had since the pandemic emerged. As a result, because we've seen quite a very quick shift from those central banks and the, expectations for interest rates to go up quite materially. And by the way, the key there is expectation. So, you know, we are seeing higher interest rates coming through, but the markets have already priced in much higher levels. So at the moment, they remain expectations. So they're clearly having causing pressures on everyday people, on businesses in terms of financing, and the sort of general inflationary backdrop has clearly squeezed the consumer and many households, not only in this country, but across the Western world. So as a result, the next sort of part of that is that recession concerns have risen. And it looks like at the moment that we may be sort of heading in that direction. As I mentioned, you know, central banks, because of the inflation data coming through, that is showing no signs of easing just yet. They are sticking to their guns as far as raising interest rates are concerned. I think I'll comment on this a little bit later, but you know, there may be a bit of a difference between what's going on in the US versus what's going on in Europe, where clearly the energy crisis in Europe has created a very different dynamic and backdrop for them. And as I mentioned, you know, the recession concerns are more demand-led. So there's a big collapse in, well, not big, but there's been a fall in activity as far as consumers are concerned. You know, people are generally tightening their belts. The cost of a mortgage has gone up, etc. So that is causing, leading to an economic slowdown, otherwise known as a recession. Yeah, look, I thought might be worth interesting to hear that. Look, so far the falls they haven't really come in any sort of associated with any sort of big volatility spikes. So it's just been a sort of general gradual grind lower for the last 7 months or so, and so it has been very frustrating, and we haven't seen something of this nature for quite some time. I think we've probably become quite used to seeing market corrections over the last 10 years lasting perhaps 1 to 3 months, and then we're off again. So clearly this particular one has just been a gradual grind lower for sort of 7 months or so now. And therefore clearly quite frustrating. If we compare the falls we saw in the pandemic, the volatility at that point was significantly higher, and the falls were about double, I think, what we've seen so far this year when referencing the equity markets, and were over within 4 weeks. So here we've had probably about half the falls seen during the pandemic over a course of about 7 months. So yeah, clearly a very different one, and we'll come into some more detail later on. So if we just drill into the sort of 3 key areas at the moment, which are inflation, central banks, and markets focusing on what a potential recession could look like. So as I mentioned, year-on-year inflation is currently showing no signs of slowing as yet when looking or measuring by CPI. You know, we've had ongoing supply chain issues, so that's really the crux of the issue, and why inflation. I mean, clearly there are several factors, but supply chain problems are probably the instigator of it all. And so yeah, supply chains are still challenged. We still have bouts of new COVID variants in different places in the world, particularly Asia, where lots of supply chains exist. China, as we know, had a bit of a wave to deal with in the last sort of 2 months or so, and it looks like they're now going through another one. And their policy is of a zero COVID policy, and therefore it makes it very difficult for supply chains to continue functioning normally. Therefore, not necessarily helping the inflationary backdrop. On top of that, we've continued to have high energy prices, as again, I'm sure you're well aware when going to the petrol pump. Gas prices remain very high and volatile. And so, those two sort of key pieces are not helping on the inflation front and are maintaining and continuing to put pressure, upward pressure on inflation. And I haven't mentioned here, but clearly wage inflation is something we're seeing as well. So I made mention of this in my quarterly note that there is an upward trajectory of wage increases, and so it's likely that inflation is sort of in aggregate heading in higher direction. I don't think it will be this high in, say, 6 to 12 months' time, but it will probably be higher than what it was a few years ago. As I mentioned, central banks have therefore remained hawkish. They have shown no signs of easing back on their willingness to raise interest rates, to ease back on their quantitative easing programs that we saw post COVID. One thing that we have definitely seen, and given that we've seen strong US CPI or inflation data, is that the US Federal Reserve has been under pressure to increase interest rates sooner. So they're still on their expected path on what the markets are expecting them to do. But they brought forward some of those increases to today. So for example, last month, they were signaling that they were going to raise interest rates by 0.5%. We had a fairly strong inflation number last month, which was 8.6%. And off the back of that, the markets reacted quite negatively. And the US Fed were pressured to, at short notice, increase by 0.75%, not 0.5%. That was the biggest move I think they've done since the 90s in one go, and it's very likely they're going to do a 0.75% increase. I think it's next week. So it looks like they are bringing forward some of those expectations and doing it now to try and head off inflation earlier. And that's more so in the US, not so much in the Bank of England and European Central Bank, which clearly they're in a similar stance in terms of looking to raise interest rates. However, given the energy crisis, particularly in Europe, I think the backdrop is much more challenged for the UK and Europe, and therefore it's going to be much more difficult for the central banks there to be very aggressive when raising interest rates. So I think it's going to be a bit of quite an interesting one with those particular areas, and I'm not entirely convinced that the Bank of England, for example, will be able to raise interest rates as aggressively as perhaps the US Federal Reserve. As I mentioned before, due to demand-led issues and reasons, and the inflationary pressures that are starting to build and have an impact on some of the corporate world, recession concerns are building. At the moment, clearly the jury's out as to what that's going to look like. I think at the moment, most are expecting a relatively shallow recession, and so manageable. And we'll go into later what exactly we are doing off the back of that and what we're thinking. But as I mentioned, yeah, cost of living, etc. Things I've already sort of mentioned. And again, all of the above. What have we seen? The bond markets in particular have been very, very volatile. Yields have swung wildly up and down. And with regards to the bond markets, I will come on to this later, but you may recall we've been very negative on the bond markets for quite a long time now. I think it's more than 18 months. However, and actually in my recent update, my last quarterly update, I can maintain my position that I prefer hedge funds over bonds. However, you'll see later that that's actually sort of turned now. So we have seen volatility in bond markets, but actually they've recently recovered a little bit. And I think that is off the back of these recession concerns building. Also, in addition to that, the markets are refocusing on quality businesses. So those that are better positioned to withstand a difficult environment, a difficult backdrop, which does actually play into our favor because they are the types of businesses that we tend to focus on. As mentioned, volatility, I think generally across the board has remained relatively elevated, but as mentioned, it hasn't spiked higher or anything, but it's just sort of been higher than what it was and kind of just stayed there. And as a result, we've seen all sorts of issues in various markets. Actions I'm going to come on to later. Well, I think it'd be better to sort of tie it all in together at a later point. So just thinking forwards, look, central banks, I think, are just going to continue to dominate what happens in markets. The narrative has all been very hawkish, has been all around them raising interest rates, expectations for them to raise interest rates. However, that could change. As I mentioned, recession concerns are building. And that could change market focus because, if there's a greater risk of recession, then the chances are that the inflationary outlook might not be as bad as currently being priced in. And therefore, that was seen, central banks are then going to be in a position where they may not be able to be as aggressive as they've indicated or as the markets are priced in. And so in a sort of strange kind of way, that might actually provide a tailwind behind certain parts of the markets. So that's something we're looking for at the moment. And I think something maybe worth adding to that is this is quite a short term, very fast changing development with regards to recession concerns. And so one gauge that we look at is the price of copper. That's a sort of bellwether for the global economy. And over the last month, that's fallen about 30%. So that suggests that we may be entering a bit of a slowdown moving forwards. And therefore, some of the central bank activity I mentioned might not be as aggressive as initially thought. We continue to believe, despite the fact that CPI data has continued to drift higher, that because of this consumer side of things slowing quite materially, and therefore demand falling, and certain businesses getting caught up in that as well, we do think that of the various components, that part of the inflationary story will begin to fall away. And so we continue to believe that at some point, maybe later this year, maybe next year, I'm not obviously entirely clear or sure when that's going to happen. But at some stage, we do think that data is going to start ease off a little bit. And so that, again, could potentially be quite a positive for markets if we saw that. And so we are obviously eagerly watching every inflation print as it comes along. Just on this, this year it has been a year where growth-styled investing, or companies that typically are in the technology sector, have come under more pressure than those that are more economically sensitive, such as energy companies. That was true up until about mid-June, where the growth areas have come under a lot more pressure than the value areas. However, since about the mid-June, and again, because some of these concerns around recession have increased, usually it's the value or economically sensitive parts of the markets that tend to do poorer in that kind of environment. We have looked at quite a bit of data. We are seeing some evidence that some of those areas that have done well early in the year, such as energy companies, have started to come off a little bit. And so when I talk about gyrations, I talk sort of tug of war between these two areas of the markets. And given that we think there's a chance that inflation expectations could start to ease, or inflationary data, that would be actually quite supportive of also the growth areas and the value. So we're going to continue to see these sort of gyrations between the two areas of the markets that seem to be dominating them over the past few years. And look, I think the key message out of all of this, because we can focus on the macro and all sorts of things as much as we like, but ultimately the most important thing is to remain focused on the long term. The majority of us have very long-term time horizons, and whilst this particular correction has ground on for about 7 months, I can appreciate that it's very easy to get caught up in the sort of short-term sentiment. Lots of negative headlines out there. The press will obviously always publish stories that are there to stir up negative sentiment. And so what we would say is that try to remain focused on the time and not to get caught up in the sort of short-term sentiment. In a few years' time, we will look back on this, and hopefully it will be in the rear view, and then the markets will be focusing on something else, as they always do every now and again. So I think we are, actions. So a key thing for us has been an aversion to bonds for really since the end of 2020, early 21, because of, funnily enough, what we are seeing this year. So we were worried about the potential for equities and bonds to fall together, and for the falls in the bond markets to be quite material. So this was sort of late 20, early 21. We were aggressively reducing our bond exposures where applicable and appropriate, and adding to hedge funds where we felt we could not only achieve a better return, but also achieve better diversification within the portfolios. So last year that worked relatively well. This year has worked particularly well for us, given what's happened in the bond markets, as I mentioned. However, the bond markets have fallen so far, and yields have got to a point where we now actually have changed our view, and I start to think actually there are probably opportunities here in the bond markets. And so some of you may have noticed that we have already been buying in to particular areas of the bond markets steadily over the past month or so, maybe 6 weeks. We've done sort of 2 lots of purchases so far. We have plans to continue doing so. And so you should, on the advisory side, you should hear from us very, very shortly with regards to further plans around what we're going to be doing with bonds. But at the moment, the sort of high level view is we're going to reduce our hedge fund exposure, buy more bonds. And that will be particularly attractive if these sort of recession concerns do materialize into an actual slowdown, because typically in that environment, bonds do quite well, particularly government bonds. So that's a key sort of piece for us at the moment. I mentioned quality earlier, so the markets are refocusing on quality companies, because again, they are in a sort of difficult backdrop. You usually fall back on companies that have very strong balance sheets, are sort of global in nature, strong market positions, they have pricing power, etc. They're the sorts of companies that typically do quite well in these environments. They've actually come under a little bit of pressure this year, but things appear to be changing for them at the moment. So thankfully, we do have quite a strong quality bias in the portfolios, and so that should begin to turn into our favor. We're also looking at differentiated funds. We have, I mean, as you know, we hold healthcare as an example across multiple portfolios. We are looking at one or two others at the moment that have a slightly different approach to the markets and investing, and don't necessarily invest in the same old names that you typically see in a standard global fund. So we've got one that's coming aboard imminently. We've got one or two other ideas that we're doing the work at the moment. So a slightly different mix with regards to underlying exposures in the equity side, but on the sort of higher level, we are definitely favouring bonds over hedge funds. Yeah, I think I've probably talked quite a lot there. Summary. Yeah, so as I mentioned, markets are likely to continue being driven by central banks. The focus seems to be shifting towards more of a focus on recession and what that could mean for markets. And I think I've probably given quite a lot of detail around that already. Inflation pressures could begin to ease, as I mentioned. That could help to alleviate market pressures. However, we do expect volatility levels to remain elevated at the moment, especially right now because we have US earnings season underway. And so, you know, there's going to be a lot of focus on what the corporate world is saying and how their earnings are looking at the moment. Actions, I think that we've covered off in a fair bit of detail already. And I suppose that covers off the summary. Maybe just worth adding one other comment around that before I open up to Q&A. We have been relatively active again this quarter, not in a way that it may be obvious. So we have generally maintained our equity allocations as they are. As I mentioned, we've got one fund that is due to be added imminently. That's slightly differentiated. We've got one or two others that are coming on board, potentially down the line. Another thing that we've been doing is with regards to currency specifically. So one area that's been very strong is the dollar this year versus the pound and versus many other currencies. But that's clearly been a help to us because we do have some funds that are denominated in US dollars. And so when you convert those dollars into pounds and you've had a strong dollar, we've actually benefited from that. So some of the falls that we've seen in our funds have not been as bad as if you were sitting in the US and you didn't have that sort of currency effect. They would be experiencing even bigger losses than us. So the exchange rate dropped to about $1.2 for every pound. And you know, if you look at a long-term sort of historical range, that's at the very low end of the long-term range. And if you look at post-Brexit, when the pound collapsed, it went down to about 1.18. So we are very close to that number. And so what we decided to do was to try and lock in that gain we've had from the dollar and add currency hedges, as they're called, into the portfolio. So in a sort of roundabout way, given whatever's going on in the markets, we are slightly repositioning the portfolios. So we've done a bit on the bonds, we've done now some stuff on the currency. So if you have a scenario where inflationary pressures do begin to ease and markets get an uplift, that will also likely cause the dollar to weaken against other currencies such as the pound. So as the markets rally, and particularly the US ones, the dollar could actually become a headwind. And so that's why we've brought in those currency hedges to remove that risk so that if there was a rally, we will fully benefit from it and not be sort of curtailed. Just one last point is that we don't want to bring too many currency hedges in, because clearly, you know, we don't know, the dollar may continue to be strong for all we know. So we've just put a little bit more in just to make sure that we balance things out. I probably talked way too much, and I would love to open up to questions from anyone who wishes to ask them.
Yeah, well, thank you, man. It's very thorough as always. We've had a few questions, and funnily enough, we did have one come in on the US dollar. Just with regards to why it's appreciated so much, perhaps you could talk briefly about that, so
Sure.
listeners can understand why it has risen versus the pound, for example.
Yeah. Look, with currencies, there's always a lot of moving parts, but the key one at the moment is the central banks and their interest rate policy. Because if you raise interest rates, let's say I'm the US Federal Reserve and I'm raising interest rates, the effect of that is to put upward pressure on the dollar. And the same thing over here. So if we begin raising interest rates, and sorry, this is relative, by the way. So if I'm raising interest rates more than somebody else, my currency is going to appreciate against that other currency. So for example, we take the US Federal Reserve versus the Bank of England. Both want to raise interest rates, but the US Federal Reserve have been much more aggressive than us. And so that's put upward pressure on the dollar versus the pound. And you can say the same thing about, well, especially against the euro, because, you know, the European Central Bank are only just now starting to talk about potentially raising interest rates by 0.25%, the first time in 11 years. So they're behind what the US Federal Reserve are doing. So as a result, what we've seen is that the dollar against the euro has moved to parity, which we haven't seen for a significant period of time. The same thing could be said about the dollar against the yen. You know, the dollar's at a 20-year high against the yen. So it's the same reason that the US Federal Reserve have been much more aggressive with their interest rate policy, and therefore it's put significant upward pressure on the dollar. And again, just going back to my comments earlier, if we saw any easing of that inflationary story in the US, that would take the burden off the Fed, and as a result, expectations would begin to decline potentially, and that would weaken the dollar. So that's why I've been very careful about trying to bring some hedges in to make sure that we don't then have the dollar as a headwind.
Mm-hmm. And does an appreciating dollar, does that have sort of a significant impact on financial markets?
It can do. It depends on which market, though. So there are. So it's actually, even US corporates themselves. If you think about large cap international US businesses that have lots of their revenues from overseas, when they bring those overseas revenues back to the US, they're converting, into a stronger dollar. Therefore, their earnings are going to be weaker, technically, when translated than they would have been otherwise. So clearly, that might be a bit of a headwind for some US businesses who have very significant overseas revenues. There are parts of the developing markets, emerging markets that come under pressure in those environments. In the environment where there's a strong dollar, this is quite often referenced in sort of amongst various commentators. But one thing I think is probably worth saying is that was much more so the case 20 years ago when EM or emerging market economies and companies were much more dollar heavy and dollar exposed, and so therefore much more sensitive. Nowadays, that's changed quite a lot, and lots of countries are actively trying to move away from the US dollar, disengage, and go to the Chinese RMB or something else. So not as bad as it used to be, I think. But yeah, clearly there are going to be all sorts of consequences with a stronger dollar in various ways.
Sure, brilliant. Okay, thanks for that. And I'm glad you mentioned emerging markets and Asia there, because one of the questions we had was regarding Asia and China and sort of the role it plays in our portfolios, because you briefly mentioned it at the start, the fact that China's struggling with COVID policies. So could you talk a little bit about the role it plays in our portfolios?
Yeah, sure. So at the moment, we have a relatively healthy exposure to Asia specifically. and as by default, China. Lots of our exposures, lots of our funds have percent of their funds exposed to China, and there is a whole range of companies that you would typically find in those funds. So it does play a reasonable part of the portfolio. It's not a huge part, but it's definitely a reasonable part. Now, what's I think been particularly interesting in the last few months is that despite the difficulties, because China, has been going through a growth slowdown that appears to be improving now. However, they've had bouts of COVID, and their stance towards COVID is to just fully lock down cities. So that can have knock-on effects as far as growth is concerned and supply chains, etc. And it creates a lot of uncertainty around China and Chinese markets. However, despite that, if you were to look at the performance of a Chinese stock market versus the US stock markets over the last 2 to 3 months, US stock markets have been doing that, and Chinese stock markets have been doing that, which might not make a huge amount of sense, but it's something that we've observed and I'm monitoring very closely, because it could be that, and actually, sorry, just to add on that, one of the key reasons for that may be that despite everything that was going on with COVID and all of the sentiment around China and the growth, etc., they are not having the inflationary issues that we are having over here. So at the moment, inflation is sort of in the between 2 and 3% in China. They have not seen a material pickup like we have over here for a raft of different reasons. And as a result, their backdrop is much healthier and more manageable and more attractive than it is in the Western world. And to add on to that, because growth has been quite slow, the People's Bank of China, or their central bank, have actually been in easing mode. So they're actually easing monetary policy, whereas over here we are tightening monetary policy. So you've got a very different dynamic going on over there. And I think you're starting to see that in stock market performance. So, I don't want to jinx it and say you're starting to observe some a change in dynamic in the market, or change in trend, but it's certainly something we have spotted, monitoring very closely. And it may be that I feel like we're maybe a little bit early, but at some point later this year, we may adjust our positioning there to take on a little bit more risk, but we're monitoring it.
Brilliant. Well, thank you for that. Another question we've had in is regarding sustainable funds. Obviously, so we've spoken previously about ESG and its importance, on these webinars before. We have seen sustainable funds come under sort of significant pressure this year, and especially versus other equity funds. How are we managing that, and what's our sort of thoughts moving forward in the sustainable space?
Yeah, look, it's very clear that the environment has not been favourable for those types of funds and businesses. I think, look, with the sustainable portfolio, which we launched in early 2019, from that point until the end of last year, it did have a fantastic run, and it was quite comfortably our best performing equity portfolio. So I suppose at some point, it wasn't going to become out. It wasn't going to continue with that level of performance, and it is coming under a bit of pressure this year, more so than our non-ESG portfolios. I think I have got into the reasons why historically, but in a nutshell, when you've got interest rates that are going up, some of the companies that find themselves in the ESG bucket just come under more pressure because of the way they're valued. And also because they've had such a strong run for a while now, there was just more room to give up some of those gains. We have made some adjustments earlier in the year, And we are currently, again, as per some of our other portfolios, we've got one that's a fund that we've come up with that's particularly interesting, that hopefully we will be adding to very soon. We've got one or two other ideas that are coming into portfolio. And the whole point of them is to try and just add a bit more diversification. And I think that's probably been a bit of a challenge in the sustainable space, is that by default, you're typically investing in, technology companies, healthcare businesses, renewable energy companies. They're the sort of typical places you go to for sustainable investing. And they've been brilliant, but unfortunately this year they've got caught up in the sort of macro, in the poor macro backdrop, and so have struggled. Having said that, by the way, we have seen renewable energy doing quite well, and one of the funds that we actually own in the sustainable portfolio, the Gravis Clean Energy Income Fund, believe it or not, is actually up this year, and believe it or not, actually made a new all-time high in the last couple of weeks, or I think it was the last week. So I think renewable energy is getting traction, and it may be because of the war in Ukraine and governments shifting their focus towards becoming energy independent. And one of the ways they're going to do that is to roll out huge infrastructure, energy infrastructure projects. And clearly we see lots of news around it. So I do think that there's probably still very strong tailwinds behind the various parts of the sustainable investing area. But in terms of the actual valuations of the companies, I mean, they've clearly come under pressure. And so again, I urge people just to sort of try and remain focused on the long term, and we are doing things in the portfolio to shift the focus a little bit moving forwards.
Yeah. Brilliant, that's great. Yeah, thank you. And I think just had one more come through, because you mentioned earlier about quality companies, and that we're focusing on increasing our exposure there. Could you just give an example of a few of those companies that might be defined as quality? You spoke about sort of the attributes that a quality company has, but it might be helpful to sort of know what kind of companies those are, and whether we have exposure to those.
Yeah, sure. So I think I'll break this up into two bits, because some of the traditional quality companies that have been viewed as high quality for a considerable period of time, such as Microsoft, for example, which is probably about one of the highest quality companies in the world, they've come under a fair bit of pressure this year, and I think their share price at one point was down 30%. So and as I mentioned earlier, whilst we have got a focus on ensuring that we have a sufficient level of quality in the portfolio because of the risk of a recessionary environment, the environment that we're just coming out of, which is the inflationary one, has not been very kind to those sorts of businesses, as I mentioned. So Microsoft is an example where we have exposure, and we're maintaining exposure. So when I mentioned earlier that we have always had a bias towards those sorts of businesses, that remains, and hopefully now that should start to come through as recession risks build. However, on the flip side, you can get companies that are perhaps a little bit more economically sensitive. And so we are looking at one particular fund, an active fund, that defines themselves as a value fund, but with a quality focus. So they will apply certain screens that will help us bring out slightly better businesses within that part of the market. So that could help to enhance our exposures in terms of quality, but also diversification. And then, on the healthcare front as well. So there's lots of high quality healthcare businesses, Roche, for example, that we own at the moment in our healthcare exposure. We may look to expand on that, or build it out through other funds.
Brilliant. Well, thank you for that. That's all the questions we've had through. So, if anyone's got any more, please send through. If not, as always, please feel free to get in touch with us or email us after the webinar. But with that, I'd just like to say thank you as always for joining. It's always great to see so many of you engaged, and we hope we sort of eased some of your concerns. And as always, Mo, thank you for sharing your thoughts.
No problem. Thank you very much, everyone.
Cheers, guys. Thank you.
Thanks.